Good morning, everyone. Today we are going to start with that week 6. It's mean previous week. As you remember, I stopped that in the middle of that slide. So we will move into that slide 16. Seems to be. That's a substantiation requirements. I covered everything and up to the substantiation requirements. Right. So this is from the previous week. So I am going to cover 2 weeks lectures today, half of the previous week and this week. So when we started, we're going to start it from the week 16. Here it is. Uh, right, substantiation. Slides 18. Thank you. Substantiation requirements. What do the substantiation requirements mean? When we have that, when we do the deductions, we must have some evidence, right? So you should have a evidence. So if you have no evidence, we cannot deduct normally in our deduction from our income tax. So question is, what kind of evidence we should have? So what does the income tax assessment ask us? You must substantiate it. It's mean you must have evidence. So it should be a written evidence. They did not ask us specifically tax invoice or invoice. They said that you must have a written evidence. So now we will see what kind of written evidence we can substantiate it for our deductions. So when we go to the written evidence, how that guidelines explain to us, the written evidence consists of receipts, invoice, or similar document. So you can see receipts or invoice or similar documents. So what the document should contain? So if the date of the transactions, the amount and nature of the expense and name of that ABN supplier, ABN of the supplier. If you have that information, wait, you maybe accept that one as a written evidence, right? But not specifically is not stated tax invoice or invoice. That may be a combination of anything, your bank statement, your credit card statement, electronic copies, that BPay reference, right? So your email and it generated receipts, right? Just like that. So when we come back to that minor claims, if you have some expenses less than $10, you no need to have this type of receipts, right? So however, how much we can go like that? Up to $200. So you have a small expenses, so less than $10. Without written evidence, we can go up to $200. So it's been cumulative total $200. Individual invoice must be less than $10. When you added that $10, maximum how much we can go? $200. That's called minor claims. For this type of claims, you can keep it a little diary to make sure that um, whenever somebody asks what kind of these expenses you to explain, right? That's sufficient. Now, second question, retention of the evidence. How long we want to keep these evidences? So normal rule, from the date of the lodgement, you should have at least 5 years. From the date of lodgement, we must keep it that evidence at least 5 years. Right? Who is liable to keep this all the substantiation or all these evidences? The liability fall into the taxpayer. When we do the individual tax return or business tax return, we're sending the declaration to the client to accept that all the receipts and all the required documents he will keep for the 5 years. So therefore, most of the time, this live obligation for kept that evidences fall under with the client. However, as a tax professionals, we must make sure that when we claim that tax return expenses from the tax return, we will make sure that client have at that point all the receipts, right? Otherwise, they will come with that different reason, and they may be end up with that big mess when they have the audit. So whenever we do that tax return, we will keep all the electronic copies in our um, XPM, Zero Practice Manager. So I will show you within a minute how you're going to upload all the documents in our system. So why we are keeping these all documents? Whenever ATO come back to the audit, so what we will do, we will provide to the ATO that copies of the documents. ATO will accept not necessary original, any form of the evidence if they can read and read in English, right? Substantiations are normally we are not sending to ATO. We kept it in our system, and that whenever audit come back, we will provide to them. It mean when we lodge in our income tax return, we are not going to provide the evidence to ATO. It will be stay with us. Then whenever ATO come back to the audit, we will provide to the ATO. Right, so that's the way that documents work. If deduction cannot be substantiated by ATO, what's going to happen? If you are not substantiated to ATO, ATO can say disallow the deduction for the expense claimed. So ATO can say, sorry, you have no evidence. We will not allow you to the deduct and take it out. But if you dishonest, or if you are involved with any kind of tax avoidance, or that tax avoidance mean if you are taking out the deduction, additionally add the deduction, you are minimizing your tax, right? If the tax office believe that, then tax office maybe impose the penalties as well. So we should be very careful when we do the tax return. We will make sure that our client hold that or kept that particular receipts. If it without receipts or without that proper written evidence, we are not going to allow them to climb, because today they may be happy they will get a couple of dollars or some more dollars as a refund, but later they may be involved with the penalties and etc. Therefore, the better way to that work with them, kept that make sure that they have all the receipts to do their tax return. Double deductions. Double deductions are not allowed in the income tax. What the meaning double deduction mean? The one expenses only can climb from the one entity, right? Or one expenses can climb with the two different reason, but total amount cannot be exceed what is the amount actually you paid, right? The amount actually you paid. So when we come back to now, we will work it out that how it's going to be that for an example, you are working as an accountant, for as an employee, as well as you running a little accounting business yourself. You paying your professional fees, for example, $500, your CPA membership. These $500 can be deducted from the both places. You can deduct from as an employee, or you can deduct as a business, right? Because you are one of the business owner. So how that going to happen? So wherever you deduct, you cannot deduct your total deduction between two places or more places, not more than $500, because maximum you can climb for your professional fee $500 from your business or as an employee from your individual income tax deductions. That's called double deductions are not allowed, right? Now we will go back to that in our Zero Practice Manager and see how we going to upload these documents. I'm sure that you all can see that Zero Practice Manager. I will go to the Steve Simit. So when we go here, you can see that's a client. There's a section called document section. So when you click the document, whatever in this client you uploaded, it's here. I uploaded something like the 6. Now I am going to upload little more. So we'll go to here, choose the file. I will do the Alexa file. No, whatever that's in your documents. Normally we do as a zip file. It means everything will be here, right? So you can write down here 2019-20 ITR. In that case, all the documents relevant to that one, you put it as a zip file and save it. You can put some notes here. This is the way that you did that. And when you click it, right, file cannot be empty. All right, I did not save, it seems to be. Yep, so it is 2019-20 ITR2. Just because already ITR1 is there. So I will put it like that. So you can see already uploaded, right? So this is the way you're going to upload. Whenever we want, we can go and check it is all the documents, whatever documents that you ask, we can send it. So when you do the tax return for the PTP or any businesses, there will be a setup like that. So you go and upload that required documents. So this can be accessed by our registered tax agent or our practice. If this need, we will open this document and go to ATO and send it to ATO whatever they are requesting us. Right? You can see it's here. So I will go back to that our original screen. So please make sure that when you start to work on that PTP or any other businesses, you collected all the required evidence and upload into that evidence against that particular client name. Otherwise, we cannot find it out, right? So you want to put it against the client's name. So when you have time, please practice this time and upload couple of documents again to your client uh, um, as an example. So what we normally do, we put it everything in a folder and ship it. So for all the documents related to that particular tax return will be as a zip file, you can see. So now we will go back to our original screen. Excellent. So substantiation documents. Now we are going to move into tax losses, right? So one of the very key important topic this year, especially because of COVID, some of the businesses may be making loss, or some of that employees may be getting loss. We will see how that's going to happen. A tax loss arises when deductions are greater than assessable income. When tax losses arise, when deductions are greater than assessable income. Now we will go and see. So, but this is totally different from capital loss. You remember that couple of weeks before we talk about the capital gain. When you have a capital loss, you go into offset again capital gain, right? That we have three different type of capital losses. We talk about that, which is totally different from the tax losses. Tax losses mean your deductions greater than your assessable income in your tax return. Capital loss mean when you say sell a capital assets, for that capital assets, if you're making loss, that's a loss. That's different from tax loss. Tax loss mean you are, if you are an individual or business, your deductions is greater than assessable income. So not capital losses are tax loss. So when we go to that, I put it some more reading material in the tax loss area. Click the tax losses. You can read it if you want some further information. So for an example, what is the tax loss? So one of your client assessable income $70,000 and his expenses $80,000. So how much that is tax loss? So assessable income 70 and deduction 80. So his tax loss will be $10,000. His taxable income zero, because we never say taxable income minus 10,000, right? So taxable income come back to zero and tax loss will be $10,000, right? 70 minus 80, $10,000 tax loss. So tax loss, can we ask the ATO give some refund because of the tax loss? No, we cannot ask. So only what we can do. So under the division 36, it means the income assessment allowed to the carry forward for the future year to offset again income. So for an example, if you are making tax loss this year, that can be carried forward to the next year. If you have an income next year, you can reduce that one without any issue, right? So now we will see how we going to offset. So individuals must offset immediately whenever it's possible, right? You can see next year taxpayer taxable income must be applied whenever available. You want to apply. How long you can carry forward? If you can't next year loss, you can carry forward other year loss, you can carry forward other year. So you can go carry forward indefinitely. However, if you are an individual, you must offset as soon as you're available for some taxable income the coming years. So you can see that a example here. um, the client assessable income $100,000 and deduction 75,000. So how much is taxable income? 100 minus 75, 25,000. But he has a carry forward loss from previous year, $10,000. So how much going to be taxable income here? 100,000 minus 75,000. So balance 25,000. So you take it out the 10,000. So 15,000 taxable income. When you do that with this one, your client may be asked you, hey tax agent, if I am paying 15,000 taxable income or 18,200, I am not going to pay the tax, right? So his question will be, most of the time the clients ask these questions. That's why I'm referring to you. So if my income 18,200 or 15,000, I am not going to pay the tax. You all know that up to 18,200, there's no tax component. So what is the question here? He may ask you, please that reduce my taxable income up to 18,200, balance 3,200, can you carry forward to future years? Because 18,200 or 15,000, I am not going to pay the tax. So better to we will go up to 18,200 this year, and balance can be carry forward to next year. So unfortunately, we cannot do like that. We cannot do like that type of um, offset in the for individuals. What is the reason? So what the tax legislation asks us? You must offset first available from the first available income. So you cannot say, I want to use this tax bracket. Can we move into the next year balance? Cannot do that. You, whenever possible, you want to deduct as much as you can. So in that case, maximum you want to deduct 10,000 your loss, everything will be taken out. And next year, how much the carry forward loss? Zero. Right? That's a one tricky point. You must clear that. Now we will come back to here. You can see this client have $100,000 accessible income, right? So how much that gap? And $75,000 deductions, yeah. And then that's $25,000 your normally taxable income. However, he have 45,000 carry forward loss from the previous year. So 25. So he want to offset everything zero. So he, now that his carry forward loss $20,000. Everybody happy with that? So that he cannot partially offset. He will offset everything as much as if there's a balance can be carried forward to the future years. Whenever future years you have taxable income, you can offset. You very importantly for individuals, you cannot use that make it benefit for that tax bracket, right? You want to do that as much as up to taxable income zero, you want to offset, right? Excellent. Now we'll move into that deduction that do not give the rise a loss. What is the meaning? Otherwise deduction rules. There are four expenses if you cannot make it tax loss. What's the meaning? If you're making a tax loss, you cannot use these expenses as a deductions. What are the expenses? Payments of pension and gratuities and retirement allowances to employees or former employees or their dependents. Gift and contribution. We talk about the donations, right? Gift or donations to the deductible recipients, you cannot use that amount as a deductions. And same thing, payments under the conversion covenant, you cannot use. And personal super contribution cannot be used. Now, I will give an example for you guys to understand this one. All right, can you write down in your notebook your tax loss $20,000, right? But you did not include up to now your personal super contribution $25,000. So how much your tax loss? $20,000. Already you are in tax loss. Therefore, you cannot deduct this personal super contribution and you cannot say my new tax loss is $45,000. You cannot say. Why? If you make it loss, you cannot further deduct your personal super contribution. So example one. Example two, assume that your taxable income $20,000. Previously, I said tax loss, right? Now I am saying your taxable income $20,000, your personal super contribution $25,000, but the personal super contribution still not included in your deduction. After finishing your taxable income, you say 20,000, your tax work, you say $20,000 taxable income, but client come back and say, sorry, I did not give you the personal super contribution. Personal super contribution is 25,000. So how much we can deduct from this 20,000? Maximum you can deduct from your personal super contribution only $20,000. So now your taxable income is zero, but how much you deduct from your super contribution? Only $20,000. So what happened? That $20,000, right? That $20,000, only you can deduct from your income tax. That balance 5,000 going to be forgone. It's mean you lost that $5,000 deduction. You cannot carry forward to anything. I will give you one more example. Your taxable income is $10,000. You provide the gift to the deductible recipient and meet the all gift conditions, and total gift $15,000. So how much we can deduct from your taxable income? Maximum. You can deduct only $10,000, right? The balance 5,000 of that gift forgone. You cannot deduct. That's called otherwise deductible or otherwise allowed. If you have a taxable income, that will be allowed to deduct. If you have a tax loss, you cannot be deduct from your income. So maximum amount you can deduct up to taxable income zero, right? You cannot make it tax loss using these type of deductions, right? That's a very important. So when you do that gift and contributions or personal super contribution, you especially that too will come up all the time when you're doing, you must do at last. When you do the last, you can see there's a taxable income, you can deduct. You cannot make it loss if you have gift and personal contributions. That the balance amount, unfortunately it's gone, you cannot carry forward to anything, no more deduction on that one, right? Now we will move into exempt income. You may remember a couple of weeks that when I start that first week, I talk about that there are two type of incomes are not taxable: exempt income and nanny, non-assessable, non-exempt income. What's the difference between two? I said that time nanny is not included in the tax loss, but exempt income included in the tax loss calculation. Now we will see how much we are going to include, how that going to treat the exempt income when we have that tax losses. Same as previously I talk about the deductible expenses, right? Like a gift and contribution, exempt income also same, right? What they are saying, when you apply and carry forward loss, exempt income first apply to decrease the loss, exempt income in current year reduce the loss the current year. So I will explain through example. That's the easy way. So can you write down in your textbook, in your tax loss, $15,000. Tax loss, $15,000 this year. Assume that you have this year exempt income, $10,000. Exempt income means, for an example, you got some disability support pension, which is not taxable, $10,000, right? So how much your tax loss? $15,000. If you have tax loss $15,000, what is that important? You must immediately take it out that you exempt income component. So taxable income 15,000, tax loss $15,000. Exempt income should be take it out 10,000. So what is the new tax loss? $5,000. So you must write this one when I'm talking, right? That's the easy way to do that. Your tax loss originally $15,000. Your exempt income should be taken out from that. So if you put it $10,000, your new tax loss will be only $5,000. Even though exempt income is not taxable, but when you have the tax loss, that should be added back. I will give you one more example. Assume that in your original question, tax loss will be $15,000. Assume that your exempt income $20,000. Now, So your tax loss will be $15,000. Your exempt income $20,000. So what's going to happen now? Your tax loss 15, your exempt income $20,000. If you take it out, 20,000 will come as a $5,000 taxable income, right? We cannot, because exempt income is not taxable. So what's going to happen? $15,000 your tax loss, you offset all the 15,000 from that. Now your taxable income is zero. You don't worry about that balance 5,000 exempt income. So why? The exempt income we are going to add back up to taxable income zero. What does the rule say? You cannot have tax loss when you have exempt income, right? But you are no need to pay that. If you have more exempt income than tax loss, you no need to pay that balance as a tax, because that's always exempted, right? So how much maximum we can offset? Only amount of tax loss, right? So whatever amount of tax loss you can offset. I'm going to give you one of the other tricky example here. You can see $25,000 your tax assessable income, and your deduction for $15,000 this year. So difference between two, you have $10,000 in your surplus or taxable income. You can see carry forward loss from the previous year. How much? $10,000. You can simply say in your taxable income 10,000, carry forward 10, 10 minus 10, 0, taxable income 0. That's the way you can explain. But unfortunately, that legislation, how it is asked, before applying your carry forward loss, you must take it out that you are exempt income. That's making worse for that your client. You can see, so before applying the loss, you should take it out your exempt income, even though there's a carry forward loss come back to you. So your 2017-18 loss, carry forward loss $10,000. So how much exempt income the new year? 4,000. To 10 minus 4, so you only have $6,000 carry forward loss now. So 10 minus 6, you have taxable income $4,000. So everybody understand very clearly. The normally you can simply say carry that your taxable 10, carry forward 10, 10 minus 10, your taxable loss is taxable income is 0. However, we cannot apply like that. So what is the rule? Whenever you saw the word tax loss from this year or previous year, all of your exempt income should be offset against that loss up to 0 taxable income. So $10,000 in our loss. And if you go back to that, take it out the $4,000 exempt income, now your carry forward loss reduced to 6,000. 10 minus 6, $4,000. This is your new taxable income, right? So very important. Whenever you use a carry forward loss, first step you want to check that any exempt income is here. That should be offset first. Then only you can balance only can be deducted from your other taxable income. All right. So it's a little bit trick, but very clearly you should understand. We whenever we applied the tax loss, we want to make sure that our exempt income is 0. Right. You no need to offset over the you know up to taxable income 0. You want to apply the exempt income. Sorry, my apology. Yeah, based on that up to taxable income 0, you must apply the your exempt income. Now we will come back. Very interesting point. Up to now, I talk about that individual tax losses. So these tax losses for the businesses, what happen? If you are making a tax loss in the business, we have 4 different entities going to talk here. One, we are going to talk about that sole trader, partnership, trust, and company. If you're making loss from the company, you can carry forward indefinitely, and when you can choose when you want to that offset that loss. Whenever you are you cannot offset the gain, in your you cannot distribute to your shareholders. Now we will see if you are running a sole trader and partnership business, how that loss going to be, right? So give me a minute. So for an example, if your business making loss, from the sole trader or partnership, so what we can do, that particular loss can be carried forward to offset the gain from the business income. However, if you meet some conditions, if you meet some conditions, you may be offset against your other income. For an example, your client is a CPA accountant. His income is 120,000 from salaries and wages. He is running a little bookkeeping business. Unfortunately for the COVID situation, he lost that business. This year, he making $20,000 tax loss from that his bookkeeping business. But he got that his salaries and wages 100,000. Now, if he met some terms and conditions, or if he passed some test, he may be reduced this 20,000 loss from the business income from his salaries and wages. That's called your business loss offset against your other income. This only possible when you have a sole trader business or partnership business. You cannot do this one for company or trust. So what is that saying that? So if you have a employment income and business income, so if you make it employ business income, business loss, right? If you make business loss, for example, in our example, 120,000, you write down somewhere. So somebody's salary, so your client's salary, $120,000. He have that a sole trader business, $120,000 loss this year. We can reduce his taxable income 120 minus 20 as 100,000 if we met some conditions, or if he passed that some test. We will see what are the tests in a minute, right? If he passed the test, he could deduct that one. If he not pass the test, he should defer that loss for carry forward for the future years, right? Whenever he make it the income from that bookkeeping business, he can offset, right? So two option you have. If you are a sole trader or if you are a partnership, if you make it the loss, you have two option. One, you can go and do the test. There are some conditions. If you met that conditions, you can offset against your other assessable income, salary or wages or dividends or bank interest or whatever, right? You can offset again other income. But if you not meet that conditions, or if you not meet that criteria, you cannot offset. You want to carry forward for the future years. Whenever you making income from that business, you can offset, same as what I discussed previously, right? So now we will see what is these conditions allow me to offset against my other income, because that's the biggest question for you this year. Because this year most of the clients maybe come back with the tax loss, so we should be ready for this type of scenario. We call this one non-commercial losses. So this could be treated separately from other income, right? The tax losses normally. So you remember that investment income. Last week we talked about the rental property income. The rental property not going to come under this rule. That's called negative gearing. We no need to do any test. If you lost from the rental property, immediately you can deduct from your income tax, right? So that, as we said last time, so we make it some rental property loss, that will be reduced automatically your assessable income. We no need to do any test, because I said several times in this workshop, the investment property is not a business. It's not hold an ABN. If you hold an ABN, you will come under this category. So investment property is not a business. Therefore, whenever you make in losses, automatically deduct from your income. Non-commercial rules not apply if the taxpayer can loss from the business activity offset from the other sources. I talk about that one. This slides in not in the original upload, what I upload in that site, but I'm going to replace today. So whenever you can, please re-download and see the slides if you're interested, or if you note down in a textbook, right? But however, these slides will be summary of the slides, what's going next 10 slides, right? If you understand this slide, it's easy for you to understand next 10 slides. So I'm going to give a scenario. Your client running a business, he lost this year $20,000. And same time, that client, that's a sole trader business, right? Or partnership share, 20,000 loss. You can either way you can get it. So second part, your income from your other job, you're working as a accountant or bookkeeper or whatever verb, that's a $30,000. You are an employee, 30,000. For in your business bookkeeping, $20,000 loss. So normal, what is the question we are going to ask here? Can we say in my taxable income $10,000? It's mean can we reduce in our income from wages minus 20,000 loss 10,000. This is the one we talked a couple of minutes before. If you meet the conditions or if you pass the test, yes, you can reduce. If you not pass the test, you want to pay the tax on $30,000, so the wages, that 20,000 can be carried forward in future year. Whenever your business making income, you can offset. Clear? Excellent. Now, what exactly we want? We want to see what are these conditions or what is the test, right? So we will go to the conditions. If you are accepted activity, right? That there are in the legislation say this rule will not applicable to that particular activities. What are the activities? If you're running a business in the primary production or professional arts, if you are running a business, primary production or professional arts. Give me some example for primary production, farm business, fisheries, or livestock. This all come under primary productions. Professional arts, that arts, right? So if you are in that industry, in your other accessible income less than 40,000. How much other accessible income here? 30,000. So if your other accessible income, other sources less than 40,000, you can say, yep, my taxable income will be $10,000. It's mean you can deduct. What is the condition here? You must have a primary production business that lost or professional arts business, and your other income should be less than $40,000. In that case, you can offset your loss again to that other income and say how new taxable income is $10,000. I think you understand now, right? So now, very importantly here, you must make sure that that's industry is a primary or professional arts, and right, all should be made the production or professional arts, and same time your other income should be 40,000 or less. For an example, if that your client say I am running a bookkeeping business, he will be not eligible for this accepted activity condition. If we say no, I have $120,000 wages, he may be not entitled for that, right? Good. So now, if you are not in the accepted activity, so now we want to do the other test. So you are not in the primary production, or you are not in that, and if you not meet that condition, you say I am a bookkeeping business, so you are not accepted activity, we should do the other test. Or if you say I am more than 40,000, we want to say other test, because you are not come under accepted category. That's called 250,000 income requirement test. So now we are going to do the other test for the client. That's called income requirement test. Your income must be less than 250,000 to add four components of the income. What are the four components? That will be come up in a slides in a minute, but you can, now I can say taxable income, in your reportable fringe benefit, reportable super contribution, total net investment loss. There are four items. If the four items together, if it's less than $250,000, you are eligible to do some more test. If your four components more than $250,000, you cannot do anything. Your taxable income remain $30,000, and that $20,000 will be carried forward. It's mean you have more than 250,000 mean you cannot offset your wages, you want to pay taxable income 30,000. If you say no, my taxable income and reportable friendship benefits, reportable super contribution, and total net investment loss less than 250,000, we start to do some test. So what is the first test? Assessable income test. So in your assessable income from that business which is you making a loss should be more than 20,000. It mean at least 20,000. What I'm saying, if you assume that your business is bookkeeping, yes, you are making a loss because of the deduction, your sales should be more than 20,000. Right? That's your assessable income should be from that business more than 20,000. If you have more than 20,000 from the assessable income, yes, you pass the test and your taxable income can be offset again that loss. If your sales say $10,000 in that business, unfortunately you cannot do that test. You fail the test. We will go to the second test. That's called profit test. What does the profit test mean? That out of last 5 years, at least you make it the tax profit for 3 years. But that they are saying out of last 5 years, at least you make it 3 years profit. Tax profit mean tax loss can no need to include, right? If you make it tax profit out of 5 years or at least 3 years, you pass the test and you can offset. So for example, if your client says, sorry, I started the business last year, he will not pass this test, right? Or he said that last 4 years I am have a loss, he cannot pass this test. So only will be out of last 5 years, at least 3 years here the tax profit. If we not pass the test, next test called real property test. So when your business real property assets, you have a business building or business land or business related asset, not your personal assets, right? The business related assets exceed 500,000. What kind of assets? Land and building and structures, right? Not to that other assets. Normal real property exceed $500,000. Yep, you pass the test, right? Now, if we are not past the test, you have no any building. I see, say, oh, I am a bookkeeping business. I am in a lease place. He will be not pass the test. So other call other test. What does the other asset test mean? He have the assets, which is other assets other than real property. He other assets more than $100,000, at least $100,000. So what kind of assets? That one example. For an example, is his furnitures and equipments and his inventory and his intangible assets like a copyright, trademark. So everything together less than over 100,000. If VJ is he passed the test, he can reduce his $20,000 loss from his income. In the other assets, motor vehicles, motor cars are not included, right? You can include your business carrying vehicle like a truck and minibus and etc. But the normal motor car, less than 2 ton or fewer than 9 passengers, not be included in this asset calculation. Otherwise, people will buy a car and say, I have other assets more than this amount, right? So everybody understand this one? This is called non-commercial losses. So if you meet that test, you can deduct. It's not necessary any one of the test if you met, you can deduct that your $20,000 loss from wages. If you not met that test, you are paying to the tax on the 30,000, balance even 20,000, you're going to defer into that in your future period. Now we will come back. So this is the one you are in the business, only it will be applicable, sole trader and partnership. And if you have a running a business, yes, we can. So expected activity, I very clearly explained the primary production or professional arts and your accessible income from other sources is less than 40,000, right? In that case, you come under accepted activity. You can offset again to that your income, right? So when we come back to that, if you not satisfy the primary production rule, you can say I am not in the accepted activity. We want to do that 250,000 income test. That's the base test. If you are less than 250,000, you can do further test. If you more than 250,000, you are not eligible to offset. You only can defer that loss. So we will see what the income requirement. You can, as I said, for sum of four elements. What are the elements? Taxable income, reportable fringe benefit, reportable super contribution, and total investment loss. Together, more than 250 mean you cannot use that rule. Less than 250 mean yes. You're going to do the four tests, as I said previously. One called assessable income test, the $20,000, profitable test, the 3 years from the last 5 years profit, and real property test 500,000, and other tests 100,000. So I will explain now all four tests now clearly. Assessable income test, during the financial year you must have at least $20,000 from your business activity, not from your other source of income. Whatever entity making loss, you must have at least $20,000 accessible income. If you have no $20,000 accessible income, we cannot apply this test, right? So our income, you all know, statutory and statutory income, everything you're going to add it, right? When we come back to that profitable test, you want to that tax profit 3 years out of past 5 years. Your bookkeeping business or whatever business you make in loss this year, past 5 years, within the past 5 years, at least 3 years, you should have profit. You don't confuse with this. This line is saying that if you have 3 consecutive years, you pass the next 2 years. I just cut and pasted from the tax office website, because all the time this question come to me. The profit should be continuously all 3 years, or you can elect any 3 years. So this terminology they're using only for if you 3 years profit, next 2 years anytime you can apply this rule, right? But if you are first year profit, second year profit, third year loss, fourth year you make it profit, mean yes, that also can be considered. Out of 5 years, at least 3 years you make it the profit, right? It's not necessary consecutive 5 years. That's a very important. I just pasted this lines because it's in the tax office already there. Sometimes students come back and ask me this question. Right, so rest of the stuff you are reading, we will move into that client, the tax loss, real property. As I said, $500,000. Your real property includes land and structures, building and fixtures and fitting. That's one. Not include your personal house or personal property, not part of this one. And that you want to work it out, what is the market value of the property at that time. Right, so when we go back to that other test, as I said, other assets should be at least you should have 100,000 for your business. That's not included motor vehicles and real estate property. You can see the very important in this line. So not only that intangible assets, we can include intangible assets like a trade marks, patents, copyrights, and goodwill, and etc. Right. So that's also your assets. We exclude all the real property, land and building not really come under this category, as well as you are not going to cars and motorcycle and similar vehicles, not included for other asset test. Now we will go back. That's right. Trust. If you operate a business as a trust, you will include the tax loss. You cannot distribute to your beneficiaries, but for partnership, you can distribute your loss to the partners. Same as sole trader, with same rule for sole trader and partnership. But the trust, if you make the loss from the trust, you cannot pass into that your client, that your other accessible income. You cannot pass into that for your beneficiaries, right? So only that way you can carry forward for the future year, right? You can carry forward for the future years, right? And same as company, you cannot pass your loss on your shareholders. Only you can pass that one for the future year to offset again. Now, if you not satisfy any of the rules here, you maybe are go and ask to the commissioner to offset again other source of income. That's called commissioner's discretion. You can ask to the commissioner, can you allow us to deduct? So when we can apply that some special circumstances, you are not satisfying any of the test, but you have some special circumstances, in that case you can. So what I will do, I will share with you guys now that page, right? So if you go to here, this is called special circumstances. What are the special circumstances include? Natural disaster, drought, bushfire, cyclone, and etc. Right? So there are some government restrictions, illness affecting key personnel also included. You can see still there is no COVID in this area, right? So we cannot go straight away and say because of the COVID I affected, I want to that special treatment. That may be come up, or we plan to go with that government restrictions, right? For example, lockdown in Melbourne is affect my business. Even though I meet that any of these conditions, I make the loss. I want to offset again my other accessible income. We may be request, but it's a COVID is still not listed here, right? So if you met any of these special circumstances, you can go and apply to that commissioner. Commissioner will review and come back. Now I will go back to that's our zero practice manager. How you going to handle this one uh, in the, so everybody can see that zero practice manager now. Seems to be all right. Yep. Right. So we'll go to the little Steve Simit again. So we make it the loss, right? So that will come up as a loss. You see, when we are loss, there's no tax payable because your taxable income is zero. So I will go back to the loss will come up from sole trader or partnership, right? So we'll go and see how much loss we have here. 122,000, that much of loss, right? So I will take it out the loss, 120,000. So we want to put it that 120,000 in here. So P9, so in this area, other income, your 15C should be so your loss. That should be minus, right? That's good, loss. Then what you want to do, this loss should be, because why this one is a different, because offsetting again are the business loss 122. If you offset from your other income, it's make it like this, right? Excellent. We will go back to that business and go to bottom. Or what I will do, I will just show you this example more detailed. That's easy for you to understand. But you want to find it out where this income come from. Right, that's good. So when we go to that income, sorry, business. So we have the loss. How much the loss we have? I couldn't find it out. 122,000. So what immediately after we should do? This loss should be go to here. I will delete and do it again, right? So you want to go to that. Can you write down in your book P9? In the P9, you're going to do that your activity, loss activity, you're going to report. How much the loss? You're going to copy this amount and go to plus, new item, and immediately paste that in the net loss amount this much. Now you are working on. What is the activity? Bookkeeping. All right. Oh, there's so many E's. Less E's. Bookkeeping. Right. So you can see what is the activity? Bookkeeping. Bookkeeping services. So now you can select your partnership or sole trader. I say sole trader. Now all the tests what you learn, it's here, right? All the tests what you learn, it will be here. Accessible income test, profitable test, real property test, other test, commissioner's discretion, art, business. So if you can deduct that one of the tests, if you pass, you can put it here. So tax office say, understand, you pass this test, right? And you can put the new schedule and non-ATO notes, you can put the notes accessible test, how that you calculated or whatever. In that case, we that your tax agent knows that how you calculated. You go to new schedule and non-ATO return notes. So in that case, or you can put it under the additional information. ATO can read it that one. So better to put it additional information. If it is needed, tax agent will be corrected. So it means you are upfront, right? Good. So now we will go back to again here. Um, so 22. So where's that one? Yep. Bookkeeping. So we put that here. Accessible test is automatically offset. If it is not, you want to go to here. Loss must be deferred. It's mean you want to defer this loss. If you want to defer this, if you not meet any of the test here, you are going to defer for the future years, right? So if you not meet any of the test, even if you not apply to the commissioner, you are going to defer the test for the future period. So you put copy this amount. If you are going to click, if you decide to put the defer, you immediately copy this amount, go to income, go to section 16, go to section 16, and you must include that amount here, deferred loss, right? Deferred non-commercial loss. First part, the partnership, our one is a sole trader, so you will put it that amount here, and again that's a non-primary, done, right? In that case, you can see taxable income is reducing. Why? You not take it out from here. If you take it out, you can see it will go up, right? So if it mean you are not going to take it out your loss from your other income, you're going to defer for previous years. That's called deferred loss. Next year, if you have some income from your business activity, you can offset this one. That's called tax loss defer. So you do that couple of exercise in this area, you can understand how you're going to work on that your tax losses. Whenever you have tax losses, there will be a worksheet you can create. So tax loss, where's that? One second. Tax offset. Sorry, that we are not in the taxable income, right? Give me a second. So if you have tax loss, if you want to apply exempt income, somebody asked that last time where I am going to put that my exempt income, how I am going to offset that exempt income offset in the taxable. So for example, income, we will go to that, take it out this one and make it as a tax loss 16. I want to take it out this amount out, right? So good. So how much that's tax loss? You can see there will be a tax loss sheet now. You can open lossless worksheet. Got it? So in the lossless worksheet, if you have some exempt income, you can put it here and reduce. For example, amount is this much loss. You have $5,000. You can see it is reducing, right? Loss available. So this is the one that I think someone asked from the class, where we are going to include the exempt income. That's in your tax loss worksheet, right? That when you have the tax loss, automatically populate the tax loss worksheet in that one. Otherwise, tax loss worksheet will be not active. Excellent. So now we will go back to that in our original screen. So this is the one we want to talk from the previous week. Now we are going with this week 7. I think we are going to talk about the depreciation this week. Where's that? So I'm going to share the screen with you guys in a second, and we can start with the depreciation. So we will go with 10. Give me a 2 sec. I'm going to share the screen with you guys. All right, we will move into the week 7 depreciation. All right, week 7, we are going to talk about today the depreciation, declining value of the assets. Asset has a limited life. It means it's a particular period of time only asset producing assessable income for us. Therefore, where that they are that's the value of the asset will be decline over the time. For example, you have purchased a car today for $40,000. After 1 year, the value of the car may be $35,000. It means you cannot sell it the same price, right? After 1 year. So how much you lost that? Today you purchase a $40,000. After 1 year, that value is 35. You lost that $5,000. This $5,000 call your declining value of your assets. So how much you are going to take it out? That's called $5,000. This is the loss for the business. So if you purchase a car for the business $40,000, and after 1 year in that value of the asset 35,000, that's $5,000 you lost. That loss going to be as a deduction from our income tax. To determine how much that you can reduce like that, we want to use that some depreciation methods. In your accounting, you use that prime cost method or diminishing value method. One of the method you use and calculate how much in your reduction for each year or how much your depreciation for each year. That's in accounting. We have two methods. However, in our tax, we have different methods to determine what is that if this amount, right? Not only the diminishing and primary cost method, we have some other methods as well. So therefore, in your accounting balance sheet, or sorry, accounting depreciation, not going to balance with that or not going to equal for your tax depreciation. So accounting depreciation we are using in our normal accounting standards to calculate the depreciation. But for that tax reason, we are using a tax rules to determine that in our depreciation. For an example, if you are a small business, if you purchase a asset less than 150,000, full amount can be deductible immediately. So how much the asset value after 1 year for in the tax records? Zero. But if you're doing through that your accounting, you cannot do because you have a asset in you. So that normal depreciation you will do in your balance sheet as well as in your P&L. So your depreciation from the financial statements and tax records not necessary same, right? So now we will move into that. So what is that? We are going to depreciate equipment and plants and tools, machineries and everything. We're going to depreciate. So declining value, depreciating assets start to decline value when taxpayer first use or it's as installed and ready for use. There are two conditions. You purchase and use it, or already with you, ready to use, you can deduct, right? Very important word, ready to use, right? So even you are not using, it's come to that your place and ready for use, and we can deduct from our income tax. That's an available for declining value of depreciating asset that's held by taxpayer at any time of the during the year. So not only the day one, if you purchase during the year, you can calculate how many days you are is ready for use or you are using that particular period. You can calculate the depreciation. The deduction available only extent asset is used for the purpose of earning assessable income. What's the meaning? If you are using an asset, your private purpose and business purpose, only you can deduct the business portion of the depreciation. You cannot deduct other percentage. Value of the assets have a two part. One called element one. Element one mean in your purchase price. So what is the price you purchase? What is the consideration you provided to that your asset? That's called purchase price. For example, you purchase a car, $44,000. That your purchase price is $44,000. But we should be careful. This 44,000 including GST or excluding GST. If your business registered with the GST, you must exclude the GST. For example, your client is registered with the GST. He is buying a car for $44,000. His cost will be $40,000. His cost will be 40,000. Your client is a little cleaner. He bought a car for 44,000. He not registered for the GST. His his cost will be 44,000 because he cannot claim the GST. He did not have any GST bas lodgement or GST registration. So depend on client have a GST registration or not, cost will be including GST or excluding GST. Client registered with the GST, he will be that his cost will be excluding GST. So 44,000 is he purchase including GST, his cost will be only 40,000. But if he not registered with the GST, his cost will be full 44,000, right? Because he cannot claim that 4,000 from his ATO separately. Element 2, there are two components of the capital cost. One purchase price and second one, the ready for use, that one you may be spend some money. For example, you are from Melbourne, you purchase a equipment from Queensland. So you want to transport that one to your place. The transport cost going to be element 2 and we added with that capital cost. You should have some insurance to that for that your transport. Transport insurance will be part of the element. Right? So anything that you are spending to take that asset for a usable condition, that going to be a part of element. Your transport cost, your custom duty, freight inwards, in transit insurance, stamp duty, insulation, improvement, initial repairs, everything going to be part of your element 2. It's mean, for example, you purchase a car 40,000 excluding GST from Melbourne and you pay $2,000 transport. How much your cost of the assets? 40 plus 2, 42,000. So you purchase a equipment from China for $100,000. You paid custom duty $10,000. How much your cost of the assets? $110,000. Right? So that's a two element in the assets. However, when you start to use that particular item, your insurance and rate and registration, everything going to be not capitalized. It will be a recurrent expenditure. Immediately you can deduct. You no need to do that declining value for that, right? In your normal expenses. That's called recurrent cost. Right, so that's would be very important. After you started to that use that car, what you are paying to that servicing New South Wales or servicing SA for your registration fee, it is immediately deductible. So after you paying that insurance for your car, is immediately deductible. But anything before, it's up to come to that your business, whatever expense, it should be capitalized, right? Stamp duty, insulation, and everything should be capitalized. Effective life of the asset. This is very important. When we talk in our accounting, we talk about the two important terminology. What is that? Prime cost method or diminishing value method. So how are we going to calculate the prime cost method? Your cost divided by number of years effective life. So for example, you purchase a car for $40,000. Effective life of the car, if you go to ATO, that's 8 years. So 40,000 divided by 8, $5,000 your prime cost depreciation for the first year. So every year 5,000 you're going to deduct from your income tax. That's a prime cost method. If you are using the diminishing value method, first year will be double, so $10,000 in your depreciation. So cost you cannot change because cost already fixed. Only thing you can change the effective life of the assets. So now we want to understand what is the effective life of the assets. The effective life of the asset, estimated period, the asset can be used for an entity, the purpose of producing assessable income. Right? The effective life of the assets, the total estimated period the asset can be used by an entity for the purpose of producing assessable income. Right? If you can't use it, you have no value. The effective life is used to work out asset declining value, the depreciation for which income tax deduction can be claimed. Yeah. So we are using that one to calculate the prime cost or diminishing value method to calculate the in our depreciation. The normal rule, we all say we will go to ATO and check that what is the effective life of the assets. However, in our legislation say, what the legislation asks us, you can estimate your own effective life, right? So for an example, for car, what you are using for Uber may be less effective life. Car you are using for normal bookkeeping business, it may be a more effective life than Uber business, right? Therefore, you must estimate how much the effective life for your business. Same model car, but your business purpose may be different. It's a different effective life, right? So we must make sure that we have a right effective life, right? So we can estimate our own based on that you are how you are using that assets, what is the purpose of the assets, how fast it is going to be tear and wear, how long asset could be used for the business, all these things, how long asset could or these circumstances be used, produce income is respectful, right? Who used it. So you want to work it out like that and decide how long that effective life, right? I can give you one example. So you work it out based on that. So for a car, for the taxi, maximum years you can use for the taxi purpose, 3 years. The most of the taxi licenses, they will given for only 3 years for new car. After 3 years, you cannot use that car for taxi purpose. In that case, taxi cars effective life only 3 years, because after that, that business not going to use that car, that will be given to the some other business or other purpose. Therefore, effective life for taxi only 3 years. Uber, we can consider as a there's no restriction. You may run, I think, 8 years old car now, but still if you run too much in a year, you can increase your effective life because it's going to be soon die that car, right? So age of the car is not an issue. How 20 years car you bought it, still you are using the business, you can see 1 year effective life of the car or 2 years effective life of the car. So you can work it out your own how much the effective life of the car. There's an indicative number. What is that reasonable number? You can go to ATO website and click this link and get it that how much it is normal effective life of that particular equipments, right? Effective life is very important, right? Method of depreciation, we're going to talk about the number of different tax depreciation. This is the two, your accounting depreciation, you all know that very clearly. Now I am going to talk some other more depreciations as well. Anyhow, I will cover the prime cost also because some of you guys are new to the environment. So prime cost method, section 4075 say you're going to calculate cost divided by effective life. Cost is, for example, excluding GST, 40,000. Effective life, 8 years. So your depreciation will be 40,000 divided by 8, 5,000. If you purchase these assets during the financial year, it means you want to proportionate how many days you use that assets. So you're going to put how many, calculate how many days you used, you put it in. If you're using private and business, you're going to include what the business percentage. Same thing for diminishing value method. You can see same formula, only the difference is instead of cost, I am using the terminology base value. And we are going to put the additional 200 percentage. Why? The diminishing value method, that's going to be give you higher reduction in that first place, then going to be gradually decrease your deductions, right? Prime cost method, equal amount every year equal amount. Diminishing value, first year going to give you higher, then going to be slowly reduce that one. So what exactly I want to explain, what is the base value, that the prime cost, the cost will be included your element 1 and element 2 what you discussed couple of minutes before, right? So in your diminishing value base effective life always rest of the formula same. We want to multiply by 200 percentage always, right? Now we want to say what is this base value. The first year in your base value will be same as your cost of the assets. It means element 1 and 2 first year. But second year, when you calculate the cost of the asset, the cost minus previous year's accumulated depreciation. How much you already deducted. That's called previous year accumulated depreciation plus any improvement to asset during the year. Any improvement to asset during the year. So how you going to calculate that second year for that your diminishing value? Adjusted value. Adjusted value mean cost minus previous year accumulated depreciation, previous year's accumulated depreciation plus any improvement, right? That's going to be in your cost for the second year, third year, fourth year. You can calculate. So I put it one example here. The first year your depreciation will be, why I put that 11 divided by 12? You can do the by month as well instead of days, right? So 1800, but if you go to diminishing value, you can see double up, right? So which method you prefer? That first year diminishing value going to give you more deduction, but the coming years it will be reduced. Now we will go to the new rule get called instant write-off rule. Instant write-off rule. It means immediately write off from your income tax without calculating prime cost or diminishing value method. Who can use that one? Small business entities can use. Who is eligible to use? Small business entities. There's a long story of this rule. You can see they started from 2012, $1,000. They increased 6,500, then 1,000, then 2,000, 20,000, 25,000, 30,000. However, when they come to this COVID situation, 12th of March, government increased this one to 150,000. What's the meaning? If you purchase a asset up to $150,000, immediately you can deduct from your income tax if you meet the conditions. What are the conditions now? New condition, you can see 12th of March to 30th of June assets. If you are a business less than $500 million turnover in a year, you can deduct 150,000. If you before that, that's a 50 million. So how much the 50 million rule? In that time, 30,000. Now the new one, you only want to focus the 2019-20 financial year. If they purchase after 12th of March, they can deduct 150,000 immediately. If they purchase before March 2020, before April 2000, after April 19, that amount only 30,000, right? Now, so 500 million, less than 500 million mean they will be eligible for this. How much they can deduct? $150,000 if they purchase after 12th of March, right? So when you bought the assets or installed the assets ready for use, you can deduct, right? The cost of assets include both amount, the paid for and additional amount spent on transporting, installing, and ready for use, right? Excluding GST component, right? So how much that one's going to be? $150,000. So however, in this one, we are not going to include any of the GST component, right? Excluding GST component. Assume that your client purchased one equipment 145,000, other equipment 140,000. How much he can climb? He can climb both. Each assets less than 150,000. Each assets less than 150,000. You purchase 10 assets, 20 assets, you can climb. However, a single asset exceed $150,000. For example, he purchased one asset $151,000. Now he cannot use the immediate write-off rule. What he can do, he can go and pool that assets. So what's going to happen? First year 15%, second year 30%, right? And the deductible balance of the small business pool end of the income year, if that's less than 150, you can write off whole amount. So if you pass that $150,000, what's going to happen? First year 15%, second year 30%. Whenever that you go down, right, in the year 15, then 30%. excluded assets. So that assets you leased, you cannot do this one. And low value pool assets, it means less than $1,000 worth of assets cannot be used. That if you already allocated to low value pool, we cannot use here. And any horticulture, including grapevines industry, cannot be used. Software development pool, not used. Capital works like a building or construction, you cannot use. And if you use the cents per kilometer for your car, you cannot use. However, the very importantly, there's a car limit. For example, your client purchased a car for $120,000. How much we can deduct, it is depend on the car limit. So I'm going back to car limit, 14th of September. So you can type it in the car limit in the ATO website. It will come up, right, at your website. So you can see car limit. So maximum you can climb this amount only. Even you satisfied the small business rule. If you purchase a car for $150,000 or $130,000 for in the income year 1920, but maximum you can climb 57,581. If next this year in 2021, that amount will be 59,136. How much maximum we can climb from the car? 59,136. So if you purchase a car, $140,000, if you're using an immediate write-off, maximum amount will be 59,136 this year, right? If you purchase a car 44,000, only 44,000 because you are under the threshold, right? The car has some special rule under the instant write-off rule. So I will go back to that my screen again. So these are the excluded assets. Now we come back to low value pool assets. Anything less than $1,000 assets, we can include as a low value pool assets. The low value is to exclude the GST credit. It's mean excluding GST, but the amount, that's a low value pool. You can put it all the assets together. For example, whatever assets have less than $1,000, your computer, your tables and your curtains and carpets and everything, if it's less than $1,000 assets, you together and put as a pool. After that, there's no name about that computer or anything. You have the pool assets. So less than the together, all the less than $1,000 asset, you make it as a one asset group. They call after that, that asset name will be low value pool asset. So the first year 18.75 percentage and second year 37.5 percentage, right? So whatever date you purchase in a year, no matter, you can climb 18.75. What I'm saying, you purchase a asset 2nd of July in that financial year, 18.75. You purchase on 30th of June, that particular financial year, only one day with you, you can deduct 18.75, right, percentage. That's called put that low value pool assets, right? You cannot allocate that to the low value pool less than $100 for the business assets because immediately you can deduct. For individual less than $300, we no need to allocate here because you can immediately deduct. And if you use that simplified rule for that any assets, you cannot transfer into here. That will be simplified deduction. And you can assets which you can climb under the simplified rule, you cannot use here. Asset which you can previously calculate the depreciation prime cost method, you can use. Some work for related portable devices provided by employer. If you purchase, you can put it under the low value pool. But if your employer provide, what you can do, you cannot use that under the low because that's provided by employer. Declining, I will cover this one little later. The last slides, I put in new slides for you guys. So capital work deductions. If you have a building or constructions, so what we can do, we can deduct that particular expenses. However, there's a restricted with that. The building include your all the building and roof, right? Not to that fixtures and fittings like air conditioning machines and kitchen appliances are assets. This is work only for construction. Your driveway, your kitchen, your pergola, that's areas. right? So the residential rental property, if it is construction cost before 17th of July 1985, cannot be deductible. But that's saying, if your construction cost before 17th July 1985, not deductible. Anything after that is possible. For an example, you bought a property which is built 1st of July 1984. Yeah, but our construction cost is not deductible. But if you do some improvement after that, in 1990 you did some improvement for 200,000, you put a new driveway, kitchen and pergola, 200,000 you spend, that 200,000 deductible. Only the construction cost before that date is not deductible. If you do some improvement after that, that can be deductible under the capital work deductions. There are two depreciation rate, one 2.5 percentage, which is 40 years prime cost method, other one 4 percentage, which is 25 years prime cost method. But 99 percentage of the time, we are going to use 2.5 percentage. However, it is depend on the type of construction and the date of construction, that will be come up as a 2 percentage or 4.5 percentage. So I will just share with you in a minute. If you click that link, you can see type of construction, when's the construction date, what is the percentage. You can see here different percentages, right? So when you have the hotel and motel different from residential properties, right? So you want to see which one you are going to use for when you start to do the depreciation. You have that link here, just click the link, it will give you. But most of the time we are using now 2.5 percentage, but this is the list which one actually you can determine, right? But the residential property, if it's anything come under after 17 that particular date, I think that's a date will be 16th of September 1987, always 2.5 percentage, right? So that's the one, your capital works. Then we will, I put it this one some of the example, but you can click on the link and see. Now real property assets, you remember we talked about the last week, when you have the assets in the property like a curtain and timber floor and furniture and kitchen appliances, washing appliances, fridge and all this stuff can be depreciated based on the diminishing value or prime cost method, whatever you elected. That's your choice, right? However, if you purchase anything less than $300, you can deduct immediately. There's a restriction on that uh, investment property. If you purchase anything second hand after 9th of May 2017, you cannot deduct, right? Any purchases you made after 9th of May 2017 for second hand item, new item if you purchase, that's fine. Any second hand item you purchase after 9 May 2017, you cannot do the depreciation for asset, but you can do the capital works, but you cannot do the rental property assets what is inside, right? Disposal of depreciating assets. When you are selling your assets, you want to do the adjustment in your accounting normally, same as here in our tax. So what we are going to do, balancing the adjustment, what we normally do in accounting, what is the sales price minus what is the book value, different between two, you're going to add as a income or you're going to put as a expense, right? If you make it that gain from your capital asset sales, that's going to be other income. If you make it loss, you're going to put the other loss, right? So now we will see how is that in the tax area. You have a termination value. Termination will mean what the value is selling the assets. Adjusted value mean in your accounting or in your tax ledger, in your tax account, what is the adjusted value? That may be cost minus accumulated declining. That's called adjusted book value. How much after deducting depreciation, what's the value of your assets, right? The termination value, the amount the taxpayer received when he sold that assets, right? So your termination value is adjustable value is bigger, termination value less, mean you are making loss. For example, you are selling asset for $30,000, but actual book value 40,000. You make it loss because your 40,000 value of asset you are selling for 30,000. So you make the loss. that loss can be deducted from your income tax. You are selling for $40,000. Actual value of the assets in the book 30,000. So now you are making the profit. So because you are selling 30,000 worth of assets for $40,000 sale. So in that case, you are making the profit. Then that should be added as a accessible income under sale of asset, other income, right? So this is going to be in your disposal of depreciating asset. So disposal of depreciating assets example, you can see 1st of July 2018, 100,000, the 100,000, you purchase a asset for 100,000, you sold for $50,000 in 31st of March 2019. You used it around 9 months and sold it for 50,000. Declining value calculated using the prime cost method. You are using the prime cost method. So first we will calculate how much the depreciation for that 1st of July 2018 to 31st of March 2019 is a 9 months. So effective life 5 years, 100 divide 5 multiple by 9 divide by 12, $15,000 in your depreciation. So how much you adjusted value? 100,000 minus 50,000, which is 85,000. How much you sold it this one? For $50,000. Your termination value 15. So how much your loss? How much your loss? 35,000. This will be tax deduction because your termination value 50. That's the one you sell it. Your book value 85,000. The difference between 35,000 should be deduction as a balancing day adjustment. Right? This is called deduction. That 15,000 also deduction under the depreciation. Right? Disposing assets, again that same example. So here that assets 1st of July 2019 purchased for 16,000 and sold it for 55,000. So now 60,000 divided by 5, so $9,000 your declining value. So your book value, adjusted value will be 51, but you sold it for 55, so you make it $4,000 profit. So that's going to be accessible income because 55,000 you sold it for 51,000 worth of assets. So this 4,000 will go as a accessible income and declining value 9,000 going to be in your depreciation. That's very straightforward. Now we will come back to the little tricky point. So you can see car limit. Even if you purchase car $100,000, maximum you can climb only car limit. For 1920, that car limit will be 57,581. So when you are selling the car, this car limit, that sales price will be adjusted. That's called when you dispose the car, when you calculate that your profit for tax purpose, you will not the accounting purpose, tax purpose, you must adjust it. So that's called reduced consideration, right? So actual consideration times car limit divided by actual cost. If you use this formula, you will get it your termination value for the car limit, right? So that any car you purchase above the car limit, otherwise normal rule what you did previously, right? Any car you purchase more than car limit, you're going to use this rule. If you purchase less than car limit, you no need to. Your normal rule what we talk about a couple of minutes before. So now reduce consideration mean you purchase the car more than that price, right? And but your depreciation only car limit. So we want to reduce our sales price to accommodate how much actually we depreciate, right? I will explain through example, you can understand. A motor vehicle purchased on 1st of May 2016 for $60,000 and was sold on this date $35,000. It had an effective life of 8 years and for the business purpose and depreciated using the diminishing value up to 31st of December 2019 and 21,325 accumulated depreciation. I 513 depreciation related to the 1920. All right, we will see one by one. The value, adjustable value of the car cost limit minus declining value. So 57,466. You can see This is 2016 purchase. Therefore, you want to go to ATU and see what is the car limit in 2016. Today 57,581. Previously 57,466. So your car cost declining value 57,000 minus how much depreciation they made up to now? 21,325. So your cost of the adjusted car value 36,141. That's very simple, right? So how I did this one? Where did this number come from? 57,466. The May 2016. What is the car limit? So you want to go to ATO and type that May 2016. What is the car value, right? So what is the car value? I think that I missed that this part. I think I did not go through this one. I will go through you guys again. My goodness. All right. So depreciating assets, when you are selling your assets, sorry, I think I did not share the screen. I will repeat again. All right. When you are disposing your assets, you must have that you do the calculation, your termination value and termination value, what is the price you are selling for your assets. So in your adjusted value, in your book value. So whenever your termination value exceed that adjusted value, you are selling, for example, your book value 40,000, you are selling for 20,000, you are making loss. So that loss can be claimed from income tax. Sorry, I couldn't share the screen previously. So your termination value is higher than the adjusted value. For example, your book value $30,000, but your termination value you are selling for 40,000. It's mean you make in profit, right? $40,000 worth of asset you are selling for 50,000. Therefore, you make the profit that can be included as a accessible income. So I will give an example. You can see here your asset is $100,000, so it was sold for $50,000, right? So you are 9 months you are using that assets. So how much 9 months in your asset declining value? Prime cost 5 years, 9 divided by 12, so $15,000. You $15,000 in your declining value, right? So it makes sense to me. Yep, that's divided by 5, 20,000 per year, 9 months, 15,000. So how much the book value of the your asset? Adjusted value 100 minus 15, 85,000. So how much? What is the price they sold? 50,000. So 85,000 worth of asset, they sold it for 50,000. So you lost that 35,000. That 35,000 can be deductible from your income tax as a balancing day adjustment, right? And depreciation also deductible. Now we'll come back to other way around. You can see $60,000 worth of assets and sold for 55,000 and March 2020, and effective life 5 years. So how much the declining value? $9,000. 60 divided by 5. So how much the book value? 51. So you adjusted value 51, but you sold it for 55,000. What's the meaning? 51,000 worth of asset. You sold it for 55. So you have a $4,000 profit. That's called your accessible income, $4,000. And your declining value, $9,000. Right? So this 4,000 will go as a other income in your other accessible income. So car declining value, this is the one that I noticed I did not share with you guys, right? The car limit declining value will depend on the your car limit for that particular year, right? So when you're disposing the car, how much maximum we can climb? As I said couple of minutes before, maximum your car limit will be varied every year, right? Car limit will be varied every year. So we want to do that adjustment based on the car limits, right? Give me a 2 second, guys. Right. So when we do that sale of the car, we want to do the car limit adjustments, right? Cost of the car limit. Okay. Right. I'm just taking that some numbers for you to explain. So if you go to here, the motor vehicle. So what we are going to do, we go into the reduced consideration for if you purchase a car above the car limit. If you purchase a car above the car limit, you must use that different method to calculate. But if you purchase the car less than that your normal car limit, so for example $40,000, you can use the previous method what we discussed. So if you are more than car limit, you only going to reduce. For example, if you purchase a car $80,000, how much you are going to depreciate this year? Only 57,581, right? Therefore, we want to see how we go when you sold that car, how you going to adjust that. That's called reduced consideration. So motor vehicle was purchased $60,000 and sold on 31st for $35,000. And he said effective years, how much the total depreciation? 21,325. Already calculated the depreciation. So 5,160 for this year. That's not a matter for us. Total depreciation 21,325. So for the car limit, it will be different for 1st of May 2006 compared with the 1920. When we do this one, we want to go back. What is the year they purchased the car? In that time, what's the car limit? If you go to ATO, that car limit for that particular period is for 557,466, right? 2015-16 financial year, in your car limit will be 57,466. I purposely did that for you to understand, to have a different car limit. After 15-16, 57,581 up to 1920, and now they change it for 58,136. So 57,466 in your car cost limit minus declining value. You already depreciated 21,325. So now you are at book value 36,141. So we all know that we are not going to reduce 60 minus 2135. Why we did not do? Because that when we do the depreciation, we can do only maximum car limit. So 57,466 in the 15-16 financial year and 21,325, that's the information here. So 36,000 your car value. Now what's the price we sold it for? 35,000. But you must adjust that amount. Why we want to adjust that? Because this 35,000 based on the $60,000 your purchase price, right? Now we will say 35,000. So what is the formula you learn in the top line, the red? Actual consideration $35,000, you got it. So what is the car limit? 57,466 that year. What is the purchase price of the car? 60,000. So if you make it out, your reduced consideration will be 33,522. Now your book value 36,000. You sold it only for 33. So difference between two, you lost that. That loss should be included as a deduction in your income tax return. How much? 2,619. But you can deduct your declining value 5,160 as well. Now I come back to a summary page here. Asset value, individual taxpayer, small business entity, right? Small business entity or large businesses, right? So I will do a quick change in the slide so to make sure we are in the right track. Give me a 2 second, guys. I will share the screen with you guys. Right. Okay. So you can see I put the 3 lines. Asset value, what whenever you purchase the assets, what kind of depreciation method you're going to use. Second one, if you are an individual, what you're going to do. Third column, if you are a small business entity, which one you're going to use. If you are a large business, how you going to do. Individual, like you and me working as an employee, or we have some investment property income, that both income fall under individual, because investment property not a business, dividends not a business. Other one, small business entity, that's at this point any business less than 500 million turnover, they're going to categorize for declining value purpose as a small business entity. That's a different all the time at this point. 500 million or less. If your turnover more than 500 million, we call you large business, right? If you purchase any asset less than $100, regardless of your individual or small business or large business, you can immediately deduct from your income tax. You no need to calculate anything. If an asset value 100 to $300, if you are an individual, you can immediately write off. If you are a small business, you can use that small business instant write-off rule, that 150,000, you can use it and write off. Large businesses, they cannot immediately write off. What they can do, they can use the low value pool, 18.75% first year, and after if they're using the full year, 37.5%. If you asset $300 to $1,000, individuals, you have the option only low value pool, full year 37.5, 18.75. Individual can use that small business rule and write off immediately? No, that rule only for small businesses. So 300 to 1,000 is a small business entity rule, immediately write off. The large businesses again should go with the low value pool up to $1,000. If the 1,000 to 150K in your value, individual only can go with the prime cost or diminishing value, and small businesses should go SP instant write-off. It means small up to 150,000 deduct immediately. If the large businesses, they have prime cost or diminishing value method. If you are over $150,000, individual again prime cost or diminishing value. The small business entity go with that small business pool. First year 15,000, 15%, then 30%, right? The full year 15%, then 30%. The large businesses, they have only option prime cost or diminishing value. So you should keep it this particular slide to understand which method you are going to choose to do that. For an example, the small business, $300 to $1,000, not necessarily use that instant write-off. If you like, you can use the low value pool, or you can use that prime cost method or diminishing value. I am saying here what is the normal available one, but you can choose the prime cost or diminishing value anytime, right? That's not going to stop you. Right, excellent. So I will include the slides and upload. So again, because the original slide not have this particular 2 slides, so you can download and then take it this particular slides. So now we will go back to our Zero Practice Manager and see how we going to actually do these depreciations. Right, so we'll go back to here, sharing, and Steve Smith. If you are an individual tax return, go to the deductions. And if you are a car using for work-related purpose, you can add in the under the D1, go to here, you can say depreciation, click here and click on here, right? You can do the depreciation here. You can select your method, which one you like. But if you are an individual, only you have diminishing or prime cost, right? You have no immediate write-off for that, right? You can include your percentage of the depreciation and it will be automatically calculated. How much effective life is automatically calculated, right? So if you are same that seats, if you are using a car, not to that, less than 1 ton or 2 ton, 1 ton or fewer than 9 passengers car, like a van, if you're using, you use this motor vehicle worksheet expenses and do the depreciation. If you are using your car for work-related self-education, you are going to use here motor vehicle expenses. If you're using your laptop or furniture for that your studies, self-education, you must use here. Your phone or whatever you're using for computer, you can use it here. That's a calculation. Any other work-related items you are using, you can use under the depreciable expenses, right? So click here. All that you asset you can list it here if it is not listed over there. But if you have some low value pool, so what you can do, you can create a schedule, lower value pool asset schedule. When you click it, it will come up here and you can add that, how much business, how much non primary produced, how much investment, right? This all the opening balances. If you purchase anything, you can put it, right? And $5,000, right? I will save it and see what's that happen. You can see now, if you go to that your deductions, right? Your deductions, everything will be listed here, right? So value depreciating relating the business here, and value relating the investment here, value relating the investment property, rental property here, other pool deductions are here, right? So that's called the lower value pool deductions, right? So now we will go back to the business. So these are the area you cannot do the SPE for the normal individuals. Now we will go to the SPE section, so business section. So you can go to that your P7, sorry, P8, and go to that down. You can see, if you see here, I want to go a little bit down, most probably. Yep. So you can see here, small immediate write-off, general SPE means small business entity, and low value pool, and other depreciation and depreciated expenses. If anything you want to deduct under the SPE, you're going to include here as a small business entity immediate write-off. Small business entity immediate write-off. However, you cannot type here. So where you are going to type about that small business deduction, you go to your P10. You can see business activity, small business activity. You click that one and climb, right? So now you can put it the your asset date purchase, right? Here, small the pool or immediate write-offs. You want to practice, go and see here P10, and I will delete this one. That's easy for you to see, and do it again. So that's easy for you to understand, right? So if you are putting in the pool, when we are going to put it, if you go past that $150,000, if you're less than $50,000, immediately you can deduct. You go to the climb here. You say you are non-primary production. We say, what is that? Your car, and you purchase first 7 2019, and immediately you used, right? And how much your purchase price? Business use 100 percentage. Where's original cost? We will say 44,000, right? So now what happened? If you go back to that, you can see USPE here, $44,000, right? Here, 44,000. So same like a pool, you can put in the pool, or low value pool, you won't include under the low value pool section, right? Are there any depreciation you can include if you have small depreciation here? Any other business assets like equipments and anything you want to do to the normal prime cost or diminishing value, you can click here and create that assets and say you like to use that diminishing value, you can use it here, right? Diminishing value or prime cost method. So when you complete it, all the depreciation will be calculated. So there are a number of depreciation questions. We put it in that this week homework. So please go ahead and do that, all the exercises using the Zero Practice Manager. In that case, you will be very familiar with this topic. This is one of the key topic you must have to work with that your clients. So now is the final turn. So we did this all. So to say to you, thank you. Right. So we will go back. So thank you your time today, and see you next week. Thank you, everyone. Looking forward to see you next week.